morning, everyone. Welcome to our research morning call. This is Wee Kwang, and today we will be having a few Phillip on the ground updates, some of the webinars that we covered, and some non-rated reports. Then we also have our CICT reinstating our coverage, as well as SG Weekly and the FOMC meeting highlights that was just held last week. So without further ado, let us begin. I'll now be beginning with Credit Bureau Asia's Phillip on the ground, based on their webinar that they held with us last week on Tuesday. Okay, so for Credit Bureau Asia, they were just listed on SGX last year, 3rd of December, and they are the leading player of credit and risk information solutions in the operating countries that they are in. So basically what they are is actually a data manager and integrator for the financial institutions and non-financial institutions. They have credit details of both individuals and corporates as well. And in terms of operating countries that they are in, you have Singapore, Malaysia, Cambodia, and Myanmar. And across all these countries that they are in, either they have a dominating market share of 99.9% in Singapore, otherwise they are the only licensed operator for Malaysia and Cambodia. In terms of Myanmar, they just got their license and started operating end of last year, but because of the current situation, there might be some delays to how the gestation period will be, which I will talk about slightly later. In terms of business segments, we see that they have financial institution data business, which is their FI data business, as well as the non-FI data business. The non-FI data business are all grouped under their Dun & Bradstreet, or sometimes you see in their announcements, it's called DNB. And next. Some of the highlights, they have a very attractive revenue model. First of all, having a very strong presence, almost like a monopoly, but not really a monopoly in the countries they are operating in, is something that commands a premium in the market. And first of all, you look at that revenue model, they are actually having their data provided by the clients themselves, and it is sold back to the clients after they actually generate insights on the information that they receive. So what happens is they build a very kind of like a cohesive network ecosystem for the data that is provided for the customers. So for example, if you're a bank and you actually have subscribed to like a Credit Bureau Asia services, you provide data to them, and in return, you actually gain access to all the data that are provided by the remaining members of Credit Bureau Asia as well. So in Singapore, this is like a mandatory membership, right? So they have access to every party's contribution of the data itself. And in terms of the fee model, you can see there's membership fees, there's subscription fees, and even pay per use every time they do a search. But the FIs or the non-FIs, they need to make a search on certain individuals or corporates credit details. It is actually pay per use. So it actually captures all parts of the economic cycle. So we know that during the up cycle or the down cycle, there is always a need for credit assessment. So in the long term, it is always on the growth trend, and you're capturing the entire industry's growth, considering that you're the only or leading market player. And in terms of their Myanmar business updates, of course, like I mentioned, they only entered Myanmar with a license in December 2020. And previously, they mentioned that they were expecting a 3-year gestation period before they actually turn profitable. What happened is that this 3 years will be used to onboard clients, gather data, and then generate some insight before being able to sell it back and probably make a significant contribution to the company itself. However, with the current situation, what we see is that with the coup and everything, there is a certain uncertainty, and they might be experiencing some delays in how the business pan out in Myanmar. However, with the business contribution from the remaining countries, they should not disrupt their main core business from other countries. And generally, for Credit Bureau Asia, they are very cash generative business. So as of the latest financial year 2020, they actually have $54 million in cash held, which is up more than 50% year on year. I think previous year it was about $34 million. And they also provided for a very near-term attractive dividend guidance. So it is not a set in stone policy, but what they do see, at least for the next 1 to 2 years, is that based on what they can control, they are expecting them to not give anything less than 90% of their profit after tax and minority interest. So all in all, I think we think that it's a very interesting company, and being a having a dominating presence in the region will definitely help boost its attractiveness. And that's it for Credit Bureau Asia. I'll now hand the time over to Jie Hui, who will be talking about Lendlease Global.
Okay, thanks, Wee Kwang. Next, we have a Phillip on the ground for REIT. We have a webinar with them recently, so here are some updates. We do cover the counter. So just some highlights from the webinar. REIT's assets mainly comprise of 313 at Somerset and Sky Complex. These are stabilized assets that generate stable income. Portfolio occupancy stands at 99% after REIT signed new leases from experiential and F&B tenants in 313. Sky Complex is 100% leased to the subsidiary of Comcast Corporation and contributes 40% to FY20's MPI. 96% of the leases have built-in rental escalation of 3.3%, which provides the organic growth for the REIT. For first half results, the REIT generally saw improved performance year-on-year. We see no refinancing needs for the next 2 years, and expiries are minimal for FY21. REIT mentioned that their interest rates are 100% hedged, so the REIT is protected against rising interest rates. In the recent quarter, we saw tenant sales and traffic improving by 19% and 12% respectively. 313 is less affected by border closures due to the trade mix offered within 313. It attracts a larger proportion of locals with greater F&B and fashion offerings, rather than luxury as opposed to other malls like Paragon down the street. Another point to note is that LV will be the only commercial REIT under the Lendlease Group. So according to the management, they will have a good deal of opportunities from L Group's development pipeline and funds under management. It's just that they'll be selective about picking their properties. On that note, they are still keen on adding more stake in GEM. They do believe that it's an asset that will contribute stable, visible, recurring income, and it helps to add the exposure of suburban malls to their asset mix. Holding a 5% stake in the fund that holds 75% of GEM, it gives LV the preemptive rights to potentially increase their stake over time if other investors divest their interest in the fund. There's also the Grange Car Park redevelopment plan to look forward to. This is done in collaboration with Live Nation, the world's leading live entertainment company, to create a lifestyle experience in Orchard Road. This is through an event space for concerts, films, and there'll be hawker sauce for local food as well. The estimated completion is in first half 22, and LV is expecting a double-digit ROI from this investment. So for the last part, in the longer term, the transformation of the district that Sky Complex is located in will probably give the property an valuation uplift. This is due to the upcoming developments in the area. The area will become the new CBD of Milan, while the adjacent zone will become a smart urban park. So there will be improvements in infrastructure. For example, they will have a new metro line to be connected to the airport. So just to conclude, we maintain accumulate for target price of 82 cents. Current price translates to a 6.1% dividend yield for total upside of 10.9% per the last report. So this is all for Lendlease. I'll pass my time on to Vivian for Southern Alliance Mining.
Thank you, Jie Hui. Good morning, everyone. So I'll be talking about Southern Alliance Mining's first half FY21 results for Phillip on the ground. Just a reminder, we do not have coverage on SEM. Firstly, a brief background. They are a Malaysia-based iron ore producer. So they will explore, mine, process, and sell the iron ore produced. And the iron ore is actually one of the main raw materials to produce steel. If you recall the initiation we did on Fortress Minerals, the main difference between these two companies is with regards to the products that they sell. So for SEM, they sell iron ore concentrate, iron ore tailings, which are used in the production of concrete, and also pipe coating materials, while Fortress Minerals only sells iron ore concentrate. So I'll touch a bit more on this later. Their Cha'a mine has an area of 225.7 hectares, which is the size of approximately 420 football fields. And they also have 3 other exploration projects, which are relatively smaller in size. So they range from 19.4 to 79.2 hectares, all of which are located in Johor, Malaysia. Moving on to the results, if you refer to the table on the left, for first half of FY21, their revenue and PATMI increased 7.8% and 47% respectively year on year. This was mainly attributed to the increase in iron ore prices. So for their ASP, it actually increased to 492.82 ringgit per dry metric ton, if you refer to the seventh line in the table, as iron ore prices near 10-year high. So if you take a look at the graph on the right, we can see that for the prices of iron ore imported to China, and this is in RMB, the prices were on a downtrend from 2013 to 2016, mainly due to the decrease in China steel production. And from 2020, for the whole year of 2020, it actually increased due to the increase in the steel production for China. And more recently, in 2021, there were corrections in February 2021, mainly due to the Chinese New Year holidays, and also more recently due to restrictions placed by the Chinese government on the steel production. So China accounts for around 70% of the world's iron ore demand, with their iron ore imports hitting a record high in 2020 and jumping 9.5% to reach 1.17 billion tons. And that is why they have such a great impact on the iron ore prices. So next slide, please. Looking at the second highlight, gross margins have also improved from 39.5% to 47.6%. And this is mainly attributed to lower sales for all their products. So iron ore concentrate sales volume, if you refer to the table on the left again, it decreased by 6.8% year on year. This was mainly due to higher strip ratio. So there was more removal of overburden and waste before they can actually extract the iron ore concentrate that will be sold to their customers. So for the first half of FY21, SAM removed about 1.28 million tons of waste as compared to 1.7 million tons of waste for the entire FY 2020. So with lower sales volume, there was also lower cost of sales, and things like logistics costs, they could reduce on that, and that translated to higher gross margins. Moving on to the last point, sales volume of pipe coating materials and iron ore tailings decreased year on year. So these products are actually waste and byproducts of production of the high-grade iron ore concentrate, which is the main product that they sell. So they are produced at low to no cost, but at the same time, they also fetch much lower prices as compared to the high-grade iron ore concentrate, which is the main source of revenue. So in turn, the revenue contribution from these products will also be much lower. And moving forward, the company will continue to invest into equipment and infrastructure, as you can see from the picture on the right, and continue exploration activities in their mines, and which is the open pit mine you can see on the picture in the middle, and also explore expansion opportunities through acquisition and development of new mines. So that's all for Southern Alliance Mining. I will now pass on the time to Natalie for CICT.
Thank you, Vivian. Good afternoon, everyone. So this is a reinstate coverage for CapitaLand Integrated Commercial Trust. First of all, just to recap on CICT, post merger with between CapitaLand Mall Trust and CapitaLand Commercial Trust in November 2020. The REIT now has a portfolio of $2.2 billion worth of assets. 11 of them are retail malls, 8 offices, and 5 integrated developments. So 96% of the portfolio is actually located in Singapore, with the remaining 4% in Germany. So CICT is the largest proxy for Singapore's commercial market. So moving on to the investment thesis. The first investment thesis, retail profiting from global recovery and rising purchase triggers. So this is largely due to the retail portfolio. So we believe that because of how first of all, looking at the suburban malls have outperformed central malls throughout 2020, and tenant sales have recovered to 101.3% of 4Q 2019 levels. So this is on the back of a larger daytime footfall, owing to hybrid work arrangements, as well as the convenience of food delivery services. And as these trends such as omni-channel and decentralization take root, so CICT will benefit from their portfolio of a balanced retail portfolio of suburban and central malls. So it will allow the network of malls and the digital ecosystem will actually allow and support tenants and potentially drawing international brands into the heartlands for expansions. So of course, the central malls currently 30% of tenant sales from central malls are from tourist spending. And in 4Q 2020, in spite of the absence of tourist spending, tenant sales actually recovered to 83.7% of 4Q 2019 levels. So of course, as global immunization gains traction as well as international borders reopen, you can expect central malls to pick up, and as mobility restrictions are lifted and more social events are allowed to continue, this will of course increase the purchase triggers as well as increase non-discretionary spending. So that's for the retail portfolio. So now moving on to the office portfolio, which is our second point here, in investment thesis here. Singapore still an office magnet. For CICT, especially because it's Singapore focused, Singapore continues to attract companies to setting up their regional offices with its pro-business environment, accentuated by the effective handling of the pandemic. So given this, we actually expect more foreign demand for office space. Moving on to the third point, manageable supply. So when we look at the retail supply, total retail supply from 2021 to 2023 is expected to average 0.3 million square feet per annum. And this is significantly lower than a 5-year historical average of 1.4 million square feet. Not to mention, most of this retail supply is actually coming as part of integrated developments. So we have, part of your retail kind of establishments. Part of your residential kind of establishments, your integrated developments. Yeah. So not really standalone malls. And when we look at the office supply, we look at the average core CBD office supply from 2021 to 2025, and that averages 0.7 million square feet per annum and is below the 10-year historical average of 1 million square feet per annum. But not to mention there are some assets that actually will be undergoing redevelopment and they will be taken offline. These assets are AXA Tower and Fuji Xerox. So the office demand is further supported by demand from relocation of these tenants. So that brings us to our fourth investment thesis, scale and stability from the enlarged portfolio. So the enlarged scale after the merger should allow CICT to pursue value creation through AEIs and portfolio reconstitution while maintaining a stable portfolio performance. So because the asset concentration is reduced, any impact from AEIs or any asset that has been impacted by AEI, the impact to the entire portfolio will be reduced because the concentration risk of each asset has been reduced. Apart from that, we believe that the stability can help CICT secure a more competitive cost of funding, in our view. Next slide, please. In terms of outlook, retail and office occupancy remain high at 98% and 94.9% respectively as at 31st December 2020. In terms of expiries, 28.8% and 22% of the retail and office leases will expire in 2021. For the retail outlook, 4Q20 tenant sales have recovered to 94.5% on a blended basis for 4Q of 4Q 2021 levels, and this should return some confidence to the retail tenants and support rents and occupancy. For the office portfolio, demand is likely to stem from technology and financial services ex-bank sectors for renewals and relocations of displaced tenants, as well as MNCs setting up regional headquarters in Singapore. So in terms of interest rate sensitivity, 83% of CICT's borrowings are actually on fixed rates, and the management estimates that a 100% increase in the interest rates will have a 0.2 cents or a 1.8% impact on DPU. So we are reinstating our coverage on CICT with an accumulate rating, DDM-based target price of $2.50. So we are forecasting a 4.9 FY21 DPU yield and a total return of 16.5%. And our TP CICT will trade at 1.23 times price to NAV, and this is close to the historical average of 1.221 times. Okay, so catalysts for CICT include AEIs, further AEIs to unlock value, as well as reconstitute the portfolio. So in terms of AEIs, CICT has several projects that are undergoing AEI, and they will be completed within the year. Some of these assets are 6 Battery Road, where there is a True Block Link, retail podium at the True Block Link for this asset at 6 Battery Road, as well as a rejuvenation of the lower floors of the asset, meaning floors 2 to 6. So of course, this means that the True Block Link, which was originally just a walkway, has now been converted into a retail aisle as well. So they will be able to, CICT will be able to charge revenue for this, for the shops along this retail True Block Link. Additionally, we have the commencement of WeWork's 7-year lease at 21 Collier Quay post AEI. So just as a refresher, this 21 Collier Quay was previously leased out to HSBC, and in 2020 they actually took back the lease after termination and rejuvenated the asset for WeWork. So of course, the biggest redevelopment project for CICT is Capital Spring. They received their TOP earlier in I believe was January, and the full completion is expected to come in the second half of 2021. So all these assets will start to contribute and also further strengthen the DPUs. Risks to our view include weaker than expected leasing demand, setbacks in vaccination, as well as the new waves in the pandemic. Of the pandemic. Yep. So that's all for CapitaLand CICT, and now I'll pass the time on to Jun Rong for FOMC meeting.
Okay, hi everyone. Thanks, Nat. So now I'll be talking about some of the key points that was presented last week during the FOMC meeting. Of course, the highlight will be in terms of the dot plot. So for those who do not know, the dot plot mainly signal the Fed's outlook for interest rate. So based on the recent dot plot, rates will remain on hold through 2023. But we do notice that more Fed officials are starting to tilt towards hawkishness. Namely, in 2023 now, there are 7 Fed officials that see a rate hike, up from 5 in December. And in 2022, 4 Fed officials are currently seeing a rate hike, up from just 1. So yeah, in a way, due to all the stronger economic growth outlook, some more Fed officials, are starting to turn more hawkish. Next, please. Okay, in terms of the median real GDP growth, there was a very strong upward revision. It was currently projected to be 6.5%, up from December's 4.2% expectation. And the key catalyst for this is, of course, the recent fiscal stimulus and the ongoing vaccination that actually leads to a stronger than expected economic recovery. In terms of the unemployment projection, it's currently projected to be 4.5%. Down from 5% in December. One key thing to take note that this is not the only indicator that the Fed is looking out for. So he actually mentioned that they are actually looking for several employment indicators. Of course, he didn't state specifically which indicators. But the concern he bring up is that the headline numbers, these unemployment numbers, does not actually capture all of the people that actually leave the workforce. So moving forward, potentially if you look towards the U6 unemployment rate. So the U6 unemployment rate mainly includes all those discouraged and underemployed workers. So discouraged could be, during COVID, they try to find a job, but they didn't manage to find, and then they ultimately give up looking for a job. But, with improving economic outlook, these people could come back into the workforce. And underemployed could be, those that used to hold a full-time job, but they lost their job, and then they actually maybe go and do, probably some part-time food delivery and stuff like that. So those are actually underemployed. That is included in this U3 unemployment rate. So there could be some inaccuracy. It doesn't give you the whole general picture. So if you look at the U6, unemployment is currently at 11.1%. So the historical average is around 8%. So definitely there are still some room that we need to go. Okay, next please. Okay, in terms of inflation, prices are expected to definitely jump this year. Main reason is because of the stimulus package. And reflecting this, the core PCI inflation expectation has been raised to between 2% to 2.3% for 2021, which is actually kind of above the Fed's 2% inflation threshold. But things to think though is that this may be partially attributed to a low base last year. And Powell actually signaled in his statement that he sees this increase in price as temporary. And he will not actually, in his words, meet the standard for the Fed's inflation goal. And if you look at the outlook for 2022 onwards, you'll see that the Fed actually expect inflation to taper downwards closer to the 2% level. Next, please. Some things that was mentioned, of course, we know that there's a continued economic progress on the back of better economic indicators. Based on the tone of the statement, personally, I suggest that currently the Fed may not be so concerned about bond yield increases thus far. And progress will be outcome-based. So what they are looking out for is actual figures that is reflected rather than just tweaking their policies through expectations. So they are going for a more outcome-based approach. And he also mentioned that advance notice on tapering will be given as much as possible. Not much details here, but we believe that it could be, we can potentially monitor for any slowdown in this asset purchase. And of course, current 10-year yield, which is a concern for the market, is at around 1.7. We may want to take note of some potential volatility if it surpasses 2%. Why? Because the previous time when the market retraces roughly 4 to 5%, that was when the 30-year yield crossed above 2%. So definitely we believe that there is some room for the yield to go further. If you look at the 2-year and the 10-year spread, after every recession, it will actually increase, maximum it will increase between 2.4 to 2.6%. So currently the spread is just around 1.6%. So definitely there is some room to grow. And currently, what we think is that currently is a battle between the market and the Fed, because the Fed is saying that they will not increase the interest rate until at least 2023. But the market is saying that, based on the steepening yield curve, they are expecting strong inflation, and they are expecting an earlier than expected rate hike. So personally, we see two catalysts that may stabilize this situation. One could be in terms of some commitment from the Fed itself. Powell is expected to speak 3 days this week, but we believe that could be unlikely that he offer any kind of commitment now. And second could be when we see the 10-year yield starts to stabilize at a certain level. So that will be, that could be a positive for the market. But currently, if you look, the 10-year yield currently hasn't really stabilized. It is still increasing. So investors may want to look out for these two factors. Yeah, that's all from me. Now I'll pass on the time to Paul.
Thanks, Jerome. I'll move on to our usual Phillip weekly next page. In terms of the macro, some of the key macro news that came out from Singapore, we had our exports numbers for February. Although the February number was a bit softer at 4%, but because of festive periods, it's better to combine January, February. So year to date, the exports are still strong, about 8%. What is growing faster is actually electronic exports. So combined is about 10%. Later we'll show you a chart, but actually the growth rate of electronic exports, I think if you look at Korea, Taiwan, is almost reaching a 10-year high in terms of growth rates. Another data point that came out was the Changi passenger numbers. I know we all know it's bad, but just to have a quick look, passenger numbers are down 97% year on year. Freight is performing better. I guess in relative terms, it's still down about 15%. There were some numbers coming out from US retail. Just a quick mention, the numbers was softer than January, but from year to date 21, the retail sales in the US is very vibrant, 7%. This is double the pre-COVID 3.5% growth rate in retail sales in the US in 2019. And you should expect retail sales could accelerate even further once the Biden stimulus comes in this month onwards. We also had some macro numbers from China, which is also very positive. I think we got like those that we monitor at least. Residential sales was up 37, auto sales rebounded some 77%. But even if you were to remove the rebound, because that was compared to a low pandemic base, it's still about low single digit above the 2019 levels. Fixed asset investments are also very vibrant. Later we just discuss, we had some results briefing by UniAsia. We just give some key highlights. And that's our tactical view. We are still positive on the market. Despite the recent rise, we'll show you a chart later, despite the recent rise in interest rates, I think interest rates are still extremely low compared to previous episodes of strong economic growth in the US. And do bear in mind that the Fed, as Chun mentioned, is looking at the 6.5% growth rate, and our interest rates and the 10-year rate is only 1.7. Below are some of the events, some of the results. Do note that we will have our usual quarterly strategy, not only just for Singapore, but US, by Juno and Hong Kong on the 3rd of April, Saturday morning. So feel free to register if you have the time. Next slide. Okay, as usual, we will run through the COVID numbers. Actually, the numbers not positive. We do see a rebound in daily COVID infections, as you can see from the blue line, the global numbers. We're actually back to a 1-month high. As we know, as we see in the press, there's a lockdown reimposed in Paris because the numbers in France, Italy, some headlines of Philippines, Brazil, they're all rebounding. So we still not globally, although it came off from the highs, but we're getting a resurgence again. Next slide. We also took a look at some of the vaccination numbers. The blue line is basically doses. Not sure how they define it, maybe just a 1 dose, but the red line, the one at the bottom, is the amount of people fully vaccinated. So right now, as of today, there's probably 400 million. And if you extrapolate it in a very linear fashion, of course, it could be faster, it could be like a J curve. But if you just linearly extrapolate the numbers, we're looking at about 3 billion doses. But when we look at the fully vaccinated, I think they're assuming that someone gets the full 2 doses. To get this so-called global herd immunity could be like, if you just do the simple numbers, it's almost 6 years. So it's quite a long way if you want to get fully vaccinated. So to get fully vaccinated, we need to ramp this up faster. Next week we'll try and look at more of the developed markets. Next slide. Okay, in Singapore, good news. In terms of the daily community cases, we had no community case for the past 9 days. The last week we had 2, but this week was 0, and the past 9 days we have none. Next slide. Okay, just a quick highlight. These are the export numbers. So the chart on the left is Singapore exports. If you look at the red line, which is the electronic exports, we are coming close to decade highs. If it goes above the 20%, we're coming close to decade highs in terms of electronic exports. So electronics remains quite robust. And the trajectory is consistent with what we see in Korea and Taiwan exports. As you can see from the red and blue line, one is Korea, one is Taiwan. But this is weighted average because if we do the monthly numbers, very volatile. We just wanted to highlight this. The growth rate is actually very, very, very strong in exports because Korea, Taiwan is mainly electronic exports. Next slide. Just a quick look at the China numbers. So you can see that auto sales is rebounding very strongly. It's a recovery because you're comparing with a very weak base because this was when the pandemic was at its height in China. The other chart on the right is pretty important for us at least. This is the amount of liquidity. This net liquidity, that means the net amount of new loans going into the banking system. So usually investors look at this as how much liquidity the authorities want to inject into the system. Usually this is good for commodities because this means the loan typically goes into real estate, goes into investments and infrastructure. But you can see that because loans in a way is controlled. So you can see that the authorities are injecting a lot of liquidity into the China financial system. So this is a positive. Next slide. Okay. This slide, just bear with me, is a bit complicated, but the blue bars you see is just GDP growth. So how much was the GDP in year 1962 to 2020 versus how was the interest rate? So the message we wanted to check was that interest rates is very accommodative considering the expected growth rate. So if you look at the table, so if 2021 using the Fed's estimate of 6.5% GDP growth rate, interest rate is only 1.7%. You can see the past episodes. Whenever US GDP was above 5%, interest rates can be as high as 11, 9, or as low as 4%. So 1%, even though it's jump off from the lows or less than 1%, it is still a very accommodative interest rate scenario. But obviously the debate now is how much higher is it going to go? And of course, there's much more leverage in the system than in the past. But our point is that even though rates have increased, considering the amount of growth that's coming out from the US, rates is still, the financial conditions are still very accommodative, and the easing is very, the monetary policy basically still very easy monetary policy based on the interest rates. And next slide. In terms of our Phillip on the ground, we had Uni Asia. I know not many will follow this, but since we had our briefing, we'll just quickly give you an update. So Uni Asia is like a hodgepodge of businesses. It's trading 70% discount to book. So what they do is the second bullet point, they do shipping. So they do bulk carriers. For those who do not know, bulk carriers are the vessels you use to carry grain, soya bean, iron ore, and also coal. It's mainly a China business. I mean, China is the biggest importer. So how much China imports will influence the rate. So for this company, they not only own the vessels, they also manage on a third-party basis and also get some fee of it. The other business they do is property investment. I guess a bit of a uniqueness here is that they actually invest in 8 office building projects in Hong Kong, but they take very small stakes, sometimes 3 to 8%. The other thing they do is to develop small 4 to 5 story projects. You can see the picture on the bottom left. The other update they gave was they used to have a hotel management business in Japan, but they had to close it down. I think our own view is that the model may not be right, because the model was not like a typical, like a Hilton where you just earn pure fees as a percentage of revenue or profit. They actually lease the hotel from the owner, and then they run everything on their own. They bear all the operating costs. So basically, they take in all the P&L. So I guess that model may not have worked. So they actually they had to wind down this business. The third point, sorry to drag this on, but the third point is we wanted to just get an update on container. We all know that there's a big rally in container freight rates. I mean, the feedback they gave was that nobody knew. I guess also them, because they sold some of their 2 or 3 of the containers before the rally. What they said was that the reason for rally is the port congestion in the US. So a lot of ships is stuck in the US ports because of the pandemic and lockdown. But their view is when the vaccine comes about, this utilization will improve, and the lockdown will kind of ease, the utilization rate will come down, and the market cannot sustain at such high levels, I guess. I think we'll leave it at that. The table, the one in the middle is just a typical office building in Hong Kong that they invest in. Next slide. Nothing much. I mean, those who follow dry bulk, because since they mentioned dry bulk, we wanted to just have a quick check on what's happening. So you can see that dry bulk used to have very good rally in 2008, 2009. You don't see the data here, but it's because China then was importing iron ore, soya bean, everything about 30-40% growth rates. Like it was some incredible number in terms of imports, and that's why the bulker rates jumped more than 10,000. So right now, even though it rebounded, but it's still soft, and the latest tonnage that you see on the 2 tables on the right, the dry index may not sustain because the imports for coming into China seem to be slowing down at least. I knew this is just a quick update. We just wanted to just have a quick check on the outlook for this segment. I think that's my last slide. We will go to Q&A, and I know everyone's asking about the CapitaLand thing, so we will see what Natalie can share, and then I will just add a little bit. We can go to Q&A. Yeah.
Okay. Thank you, Paul. I'll first address the questions relating to CapitaLand. So I see a few of them right now. First of all, could your team provide a layman explanation on the effects of the shareholder announcement by CapitaLand earlier today? Another question, similar also, comment on the CapitaLand restructuring announcement and the positives and negatives of the restructuring announced by CapitaLand. So I'll just take all these three questions together. First of all, what was announced today? Just a recap. CapitaLand, they have always sort of grouped their earnings into three buckets. First of all, would be the development revenues. So this is in relation to rather the property development, the sale of residential units, as well as strata units, commercial strata units. So that is one bucket. Second bucket, of course, is the fee income. So fee income is from the lodging platform. So CapitaLand has a hospitality arm, which is the Escort Limited. So the Escort Limited is not the same as Escort Residence Trust. So what that platform does is actually they're like a franchising model, very much like your Hilton, your Marriott, your International Hotel Group, IHG. So what they do is that they actually charge a fee for letting all the other hotels and service residences use their name, as well as provide some sort of service in relation to how the assets should be run in compliance with the standards of their assets, like the Escort, Citadines, Somerset, etc., stuff like that. So then the last bucket, of course, would be the fee income from the fund management platform. So the fund management platform, under this fund management platform, there are actually two types of assets. First of all, is the listed REITs, which I'm sure a lot of you are familiar with, the listed REITs, as well as the fund management platform also manages private funds, which are not listed. Yep. So how they earn revenue from the private funds would, from this private funds, this fund management arm would be they charge a fee for the management of the assets, and the management of the investments. Okay, so in a sense, the lodging arm, the lodging arm as well as the fund management arm, these two are the sort of stable, recurring drivers of revenue. And also, not to mention, there's also the investment property assets, which are CapitaLand's ownership of some of the office assets, as well as the malls. Some of the malls they own are, for example, Ion Orchard. So when they own Ion Orchard, they earn stable revenues, and that is also part of the investment property.
Natalie, can you just go straight to the deal? I think most people know what they actually do. You can just go straight to the deal and explain what is the impact of the deal.
Okay, so for this deal, what happens is that they are now carving out the fund management and the lodging arm, and they will be privatizing the development arm of CapitaLand. So and in exchange for this, so they will end up listing the fund management and lodging arm together, and it will now be called CapitaLand Investment Management. So that will be the arm that is now listed on the SGX. And the consideration for this transaction, it will be paid, the implied consideration value, it will be $4.10, and 69% of it will come as a share in this new listed entity, CLIM, CapitaLand Investment Management, CLIM. 69% of it will be a share in this asset, as well as 23% will be a cash consideration. So this will be about 95 cents. And then also the last part of the consideration will be CICT units. So that will be 8%. Yeah. So that's equivalent to about 0.75 CICT units. So this will be the consideration, $4 total implied consideration, $4.10. And if you compare to how CapitaLand has been trading, the last close for CapitaLand was $3.31. So this is a 24% upside to the $3.31 last traded, as well as the 5-year VWAP, $3 and also the $3.31. Yeah. So in a sense, I guess in a nutshell, what CapitaLand is trying to bring across here is that the implied consideration is actually fair consideration and above the VWAP as well as the last close. Yeah. So in a sense,
let me let's take a shot. Okay, so if you can see from the table here, so CLA is basically Temasek. I mean, it's a fancy name. Just consider them as Temasek. So the problem they always had was that CapitaLand always traded below book because it's got caught up by the development business. So as a result, like what Natalie said, what they're going to do is they're just going to, so CLA Temasek is just going to buy the development business. So we are all here, all of us shareholders are here. I mean, I'm not a shareholder, but all the shareholders. So in return of buying the development, what are you giving us? Because we're going to sell you our development business. So in return, what they're going to give the shareholders is all these things. So they're going to give you the like Natalie mentioned, the CLIM business, which is all the fund management business. And I think it's at book value. Then the other thing, they're going to give you shares. So we are shareholders, there's not enough, you've got to give us more. So they're going to give us CICT shares. So I mean, I don't have the details, but it looks like a good deal for the shareholders. The reason I say this is that they are buying my development business at 0.95 times. Of course, you can argue it's not book, but most developers trade below book. So that is a positive, number one. Number two, they're giving me this, if I'm not mistaken, should be at book. Natalie, correct me. If they're giving me this at book, this is a positive because this will become a capital-light, purely fund management, recurrent fee income, which typically can trade as much as 2 times book. So if they give me this, so in a way, it's a positive. So I see I'm selling you my development business at 0.95 is, in a way, is reasonable and a bit positive. And then I'm giving you this at book, which is positive. Of course, cash is always positive. So the only thing is this one. So CICT might face some selling pressure because I think they are issuing, correct me around again, Natalie, about 300 million plus units to minority shareholders, which, obviously not everyone's going to keep it. And if I know someone else is going to sell, so there could be some selling pressure on CICT. But it looks like a good deal on paper because if this is at book value, then typically, I think they showed a chart. Sorry to flip all this all over. Typically, such businesses can trade at almost 2 times book. I'm obviously getting it at the wrong page. Sorry, everyone, please bear with me. Yeah. Okay. So if you look at real estate investment management, I mean, these are just pure managers. Like I think they got like BlackRock and all that stuff. So these companies can trade at 2 times book. And again, I'm just picking the numbers. Okay, we didn't verify anything, but if you look at this, it looks like like they said, real estate investment management trade at a premium. And these are the companies like Charter Hall, I think Brookfield Asset. So it looks like a good deal for investors because development assets don't trade well in terms of the valuations. So they're taking it out from us and giving us cash and CICT shares. Correct me if I'm wrong, Natalie, you got anything there? Yeah.
Yeah, I think that pretty much sums up everything. Yes.
Called real estate investment managers. I mean, we'll do a note later, but this is just our first cut of. Sorry, let me turn on the video. Since we're supposed to turn on video for Q&A. This is the first cut of how you read it, but it looks like good deal for CapitaLand minority shareholders. Yeah, maybe for once. Yeah. Okay. I think we can move on to the next question. I will stop sharing. Okay.
I think sorry, let me turn on my video as well. Okay. Okay, I have a few questions on Credit Bureau Asia. Just a note, we do not cover them. This is just based on what I remember from the meeting that we had last week. So there's a question. Credit Bureau Asia model looks good, but it now seems overvalued at PE of about 40, and with Myanmar potential on hold and underdeveloped Cambodia market with a very small 16 million population. What are your views? Then there's also there's also another one which I'll take on probably at the same time. The business model is lucrative with its geography dominancy and regulatory backing. Any risk, any ratio you can quickly share, like PE and margins? Okay, so I think the main thing, of course, if you just look at the PE alone, it will seem a little bit overvalued at this point in time. And of course, we do not have any models for it, so we can't really tell whether there's any other valuation backing behind what they are currently being valued at in the market. However, I think generally, if you take a look at the whole story that they actually bring to the market is that the fact that they are the sole player or the biggest player with a lot of room for growth in the region, that is something that it cannot be written off. And of course, with their strong cash position, what they are doing is also they have the opportunity to expand out into their target markets that they want to go into. Of course, right now we do not know whether they have any plans to do that, but I mean, this is nothing that is out of the question for them. They can take on some of this expansion in the near term. So, and I think for some of the potential of these underdeveloped economies, of course, it is both like an opportunity and a risk as well. However, what they did mention was that, where we talk about a lot of these new digital banking systems that might come into play and kind of override them in the credit market, what they actually think is that these new digital banks or players that are coming into the underserved and underbanked market might actually become their customers, because they need to do some sort of credit screening as well. So this they might actually get on board to Credit Bureau Asia's business. So that might be an opportunity. Might be I don't know how far the digital technologies will actually propel this forward such that they become useless in the market. But right now, their services are still very essential in their operations. I think I took a quick look at the margins. If I'm not wrong, the net profit margin is roughly like 30 to 40%. So yeah, it is a very lucrative businesses in terms of margins wise, if you just take a look at it. Yeah, and I think that's it from my side for Credit Bureau Asia.
Paul, I think, hi team. So I'll take on the next question. So yeah, okay. So let me share. So okay, let me see. Wait, hang on. I start my video first. So sorry. Okay, so pardon my video quality. So it's not very well. So it's a bit messy. Yeah. So okay. So first of all, I think I have a question on the update on the Thai BEV. So the only update I have is Thai BEV actually went out and then hit my stop loss for the sell order. However, if you look at the support level here, that has been tested I think quite multiple of times. So I think there's some sort of weakening of the support area. So therefore, I think that I'm eyeing some sort of like a selling off downside, and then possible support is really at this level between let's see, so it's around 0.650 to 0.675. Okay, so yeah, this for Thai BEV. So the next one is actually on Maple Tree, industrial ascenders, and then and so on. So yeah, let me see. Okay, so next one is, let me pull away. So Maple Tree Industrial. I did have a sell order on my report, so it did have a sell off. But take note that there's like a pullback, quite a strong pullback, I'll admit. Whether that it will sustain another upside is really depends on the resistance at 2.81 to 2.85. So if the resistance actually is being broken, then we can see that, okay, this descending triangle will be invalidated. But judging from last Friday and today's movement, expect some further push up to test the higher region at 2.81, which I mentioned, to 2.85 resistance level. That I think that will be happening within these past 2 weeks, the next 2 weeks. All right. So for the Maple Tree Logistic, support zone 1 was very well supported, no doubt. But the recovery is still needs some confirmation. So I expect that price is going to pull back to $1.80 back again, and then to test the upper resistance zone at which I mark out at 2.07 to 2.11. That will be like the midterm resistance zone level that I'll be targeting. First round didn't really target that well, so it fails and then get well supported at the support zone, and then price is going to rally back again on the upside again. All right. So the last one is Ascenders. I think Ascenders was very good, given the fact that it rebounded at the bottom at 2.88. It fall short of 2.81 was really my target. Actually, 2.80 was really my target to aim for a rebound. But since that it rebounded at around 2.8. Let me see the lower price at 2.83, 0.02 cents or short of the target rebound zone. Then I think that once it break out strongly, especially it break up $3.80, 18 cents, then we can see the further upside once again. All right. So with that, I'm going to look out for other questions, but at the same time, I'm going to pass my time back to my colleague. All right. Thank you.
Thanks, Miriam. I'll take some of the questions right now. There's a question here regarding, in view of the increasing trend for work from home, will this significantly affect earnings of office REITs? If yes, which REITs will be less affected, if any? Generally, yes, there has been some impact for the office REITs. Some of the office REIT managers have shared that a handful of tenants have actually reduced the amount of space leased upon renewal, to the tune of around 10 to 30% even. So that has been some of the impact towards the with regard to work from home. So I think it's not so much that they are completely moving, but I think some of them have reduced their overall footprint. Yeah, and which REITs will be less affected, if any? So I think that really depends on the current occupancy, or rather the vacancy risk presently, as well as the percentage of the leases that will be up for renewal in 2021. So just glancing, some of the REITs with slightly lower occupancies would be, for example, Suntec, their towers, they have a slightly lower occupancy. Of course, there has been some backfilling that is in progress, and for OUE also, OUE CT also, with regard to their One Raffles Place asset, the occupancy there is, I think, around the 70% range. Yeah. So apart from that, we look at the rest of for example, CICT. As mentioned earlier, if you recall, the office occupancy is about 95%. So I think that is generally there's less vacancy risk presently, and I think moving forward with the demand from relocated tenants. So this relocation actually is quite significant supply that will be taken off due to the redevelopments, about 1.2 million square feet of supply that will be taken offline. So that should actually help with the available stock. And so in that sense, I think the short answer would be we think that CICT will be more protected. Also, in a sense that they have their retail portfolio and a small portion of almost 7% of on long leases to their hospitality tenants that are located in Raffles City Shopping Centre, which is the Fairmont and Swiss Hotel. Yeah. So sorry. So just to circle back, just now we were talking about the consideration for CICT. So yes, the stake in CLIM would be at NAV, and for the units, sorry, for the consideration paid in CICT units, there will actually be no new issue of CICT shares. But what will happen is CapitaLand is actually paying out their stake of CICT shares. Yeah, so they presently own about 25, if I'm not wrong, % of CICT. So they will be paying the CICT units out of their own shares that they currently hold. So there will not be any expansion of the unit holder base for CICT. But that being said, what Paul said is correct. Of course, there are those unit holders who were given these CICT units, against their own wishes because you cannot control it. They might actually want to sell away their position, and that might actually result in selling pressure for CICT. There's another question here with regards to what is the effect on Ascendas REIT with respect to the strategic announcement announced by CapitaLand this morning. So for this new CLIM entity that will be listed under SGX, they will actually hold about 10 billion in AUM of investment property. So if there were any acquisitions that that Ascendas, or any assets that Ascendas might be interested in acquiring, it might now come from this listed entity CLIM instead of CapitaLand previously. Yeah, so I guess that's the main difference. But apart from that, I don't really see any impact to Ascendas.
Yeah, I think that there was a question. Let me just rephrase again, because it's a very complex transaction. Let me just rephrase what is this transaction about based on what we read so far. I mean, there's a briefing, I think 2 o'clock, but I think Natalie can fill in the details. So basically, Temasek is coming to CapitaLand and just telling CapitaLand, hey, I want to buy your development, property development business. Because property developers are always valued so low, right? Sometimes you won't privatize them at 0.7, 0.8 times book. So, Temasek come and then they say, oh, I'll buy over CapitaLand, I'll buy over your development property. Then, of course, as shareholders of CapitaLand, we will ask Temasek, hey, what are you going to give us in return? So once you buy that out, we will have CapitaLand, excluding the development, will still have the best parts of the business, in a way, the fund management, the REIT manager. Then of course, investors will say, that's not enough. You buy, what are you going to give me? So I'll give you cash. I will give you some CICT shares. So basically, that's the transaction. I know it's very complicated because there's a transfer of this thing. I think they will buy it at about almost 6 billion NAV, but they're buying it at 0.95 times. So that's the valuation. Yeah, I hope everyone can understand. It's as simple as that. Like they're just buying the development and just giving you cash and all that. So we think it's a good deal. I think. Yeah, and fund management is always the best. Property developers, I mean, nobody will give you any PE, maybe one-time PE, because after one project you got no earnings. But if you are doing if you have a REIT manager, people can give you 15 times, 16 times, because there's recurrent income. And REIT managers has the best type of recurring income, because it's almost impossible. Not impossible. It's very, very hard to get rid of a REIT manager. And your asset, you're not like running a unit trust where the funds can, 1 year sometimes are up, sometimes are down. But when you're a REIT manager, the quality of the recurring income is one of the best around, because the assets don't really change. So if you run a 100 billion REIT, more or less the value is more or less there. You make acquisition, you earn fee. You sell property, also you earn fee. So the quality of a REIT manager platform is actually very high, like ARA. I know these are really, really very high quality recurrent earnings. Yeah. Anyway, I think Natalie, once she will give you more details, but no, because she hasn't gone to the presentation. This is as much as we know for now. Thanks.
I think just to reiterate on what Paul said, it really at a 0.9 times for the developer part of the portfolio is actually like you mentioned, it's already above how CapitaLand has been trading, and another part is that we know that one of the selling points for CapitaLand has always been their very stable recurring income from the investment property, as well as the fee income from the lodging and the fund management platform. So that has always been one of our selling points for CICTs, for CapitaLand. So right now what's happening is that they are isolating the golden goose in a sense, and then putting that up. So that is of course positive. And not to mention, Paul also mentioned that, you know, these fund management type of listed entities tend to trade above book value, above book valuation. So that in a nutshell, we view it like positively. I think Jin Rong has some questions. Jin would like to take some questions.
Sorry, yeah. So I see the next question is on, may I know why there is a concern of inflation when the 10-year treasury yield increase? What is the relationship between the two? Okay, first of all, it's not just in terms of concern of inflation, but it's the pace whereby the treasury yield actually increase. Okay, but maybe I first just brief on the relationship. So when you see the yield curve, you can just see it in terms of investors' inflation expectation. Why? Because if they were to expect higher inflation, so they will actually sell off the longer term bonds, because inflation will actually erode the value of each dollar. So they will actually sell off the longer term bond, and that will actually cause the yield to actually increase. And but now the problem is that we know that we are looking for a very strong economic growth, and with that we are looking for a strong inflation. But I think what markets are worried about is in terms of the pace whereby the yield curve steepen, because if it steepen much faster than expected, they will expect Fed to actually pull the plug on the monetary support, probably in terms of a rate hike itself. And usually a rate hike, there will be a near-term reaction whereby the market doesn't really favor a rate hike. But overall, if you stretch it out to the longer term, I mean, we do believe that the corporates may have the ability to absorb the increase in the cost of debt and all that. Yeah. So we believe that it's just probably a near-term knee-jerk reaction from this issue. The next question probably I'll just try. There is currently a silicon chip shortage internationally, not just for computer parts, but this even affects cars. Okay, yes. How would this affect the value chain that relies on silicon wafer? Okay, if you look at the catalyst of why there is actually a shortage in just semiconductor chips, you realize that many of these issues is temporary. So temporary just means that ultimately, once we have the production that ramp up, okay, we'll start to clear all these backlog, and things will actually start to normalize. So the catalyst that affect, this semiconductor shortage, one is of course due to COVID. There's an increased demand for electronics. So that one moving forward, when things eventually normalize, okay, the demand may still remain high, but ultimately may start to taper as compared to 2020. And then of course the second catalyst is that there's limited manufacturing capacity from many of the chips maker. But you can see that they are actually this year they're actually committing money to boost their production capacity. TSMC is planning to open a new factory in US, or even Samsung is planning to open a new factory also. So this will ultimately, once it managed to start production sometime maybe 2022, then all these shortages problem may start to ease. Yeah. Okay, maybe I see one more question which I will try to answer. It's on stagflation. So it says, so if there is stagflation due to an assault on economy ranging from conflict with China to infectious disease, Fed will still raise interest rate. If they just print money to force 10-year treasury down, will that crash the USD or induce, will that crash the USD or induce hyperinflation in USD then? Okay, first, personally, I believe that there may not necessarily be a stagflation. I mean, if you want to have a stagflation, it actually points to a poor, kind of poor economic growth. But if we look ahead, the economic projection for second half of the year is actually very strong. And of course, if you are looking for in terms of a reopening, potentially, there could be boost the employment in terms of those retail, entertainment and hospitality sector. So there is a little chance that we may have a stagflation there. Here. And of course, if you are saying that Fed print money to force the 10-year treasury down, I mean, if they really want to do that, I mean they can, but I see it as unlikely. Okay, because they have actually, they may have other tools on hand that can actually just to hold this 10-year treasury down. I mean, of course, they can provide their forward guidance. They could be more specific in the conditions that they will be met before they actually increase rate and all that. And of course, I mean, the worst case, they can just use a yield curve control. And they actually apply it last time in Japan, whereby, with yield curve control, the markets tends to just adjust itself without the central bank having to do as much of the asset purchases. Yeah, so I mean, of course, currently I don't think the hyperinflation may be an issue in US currently. Yeah. Yeah, with that, I think I don't have any other questions. Maybe my colleague will want to take some.
Very
Okay,
quickly,
so-
I'd like to touch on,
sorry.
let me just finish up with this. Besides any possible selling pressure for CICT, will this restructuring have any impact on other CapitaLand REITs such as Ascenders, Escort, and Escort Residence Trust, etc.? So no, we don't think that there will be any other impact for the rest of the REITs. So the main REIT that will be affected will be CICT. And another similar question would be, is this beneficial for CICT shareholders? So of course, apart from the possible selling down of CICT shares, there won't really be any impact. Of course, we look more at the assets of the portfolio, which, if you recall from our earlier slides, they are actually dominant and very stable assets. Be it office assets which are located in the CBD, as well as a very balanced portfolio of retail and suburban retail and central retail. So yeah, there might just be some selling pressure. That's about it. Sorry, Miriam, please go ahead.
Sorry, everyone. So, yeah, the next question I have is on the city development and IFA. So why don't I start with city development first? Okay, so with city development, you can see that it has actually broken out of the falling wedge, or you can call it the descending triangle if you like. Either one is fine. But if you look at it, our resistance zone has been tested quite a number of times. Okay, so quite a number of times, like 1, 2, 3, 4, and 5 was previously an ascending triangle, but price breakdown gets supported once again at 7.25, and then this time around, I think that price is going to hit up higher. Not sure, but I have a pretty good feeling that this resistance zone is going to be broken. All right, especially today that you have seen that there's a very strong bullish Marubozu candle that is not yet to confirm. We need to confirm at the end of the day. All right. So yeah, then next one I'll move on to the to IFAS. IFAS did have a strong sell-off, on the start of Feb, and then price has started to decline. Right now it start to has filled up the gap already. So and then it broke up on the upside of the falling wedge, which is a bullish continuation pattern, of course. But next one is, are we going to see $6.50 being broken and then followed by $6.68? This will be the next challenge. Also 6.24, you need to take note that this is a very immediate strong resistance ahead. So for IFAS, you don't confirm the upside, 6.24 or 6.25 will be the next likely resistance level you need to take away. All right. So I move on to the next one. Okay, so I got Yang Zijiang. I first already touched. I think Yang Zijiang, I think is quite a like a strong contender. First of all, I think it broke off my first resistance already. Secondly, I think some correction. I think target resistance, second target resistance at 1.34 to 1.38 will be my ultimate target. But however, I think that based on what I've seen, I think that I'm going to see some minor correction or ranging around here before it tests up this level. So once this level 1.34 is broken to 1.3 is broken, I think 1.49 will be the next target that I'll be seeing as well. All right. So yep, thank you very much. So next one is Dairy Farm. Okay, so for Dairy Farm has been on ranging for a part of it has been ranging. If you look out for the Ichimoku, I think it doesn't really give you a clear signal for right now. So hence, I'm more inclined to look at the short term. So the short term, I will look at price is going to test 4.76 to 4.67 region before we can actually decide on anything. All right, so if this level is broken, then we can see that the next level at $5.40 will be tested in the long term as well. All right, so this is what I have for Dairy Farm. I'm not very sure. Okay, so yep, this is the question answer. And I think the next one is CICT C3, the technicals. I think in as much I think is very much affected by the news that which Natalie and Paul shared today. So the technical really shows that for CapitaLand is only like a piercing line above the immediate support at 3.29. Resistance level, we can see a gap here between 3.35 to 3.4. So less likely if this is fallen, then we can see that this group or candle will be a failed bullish Hikake. Means that there's an snell and trap, and then the price will continue to fall. So for CapitaLand, although long-term wise, it's quite bullish for now, but we still need to be sure that the three bearish end wave up is still ongoing. Uptrend bullish. I think what Ichimoku is showing a very much ranging price trend now. I can see that price is trending above the Ichimoku cloud, but I think the Sengo span A and B is still inverted into a bearish scenario. All right, so yep. So next one is okay. I move on to Capital DC REIT. So Capital DC REIT, sorry, not CapitaLand. Okay, so so pardon me. So Capital DC REIT, I think the decline, I think the rebound wasn't that strong. So right now, I think that I'm looking at a flag formation for this. So I think I'm really not very sure about what Capital DC is going to go forward for now. So hence I won't comment much on it. So the next one is, I think, CapitaLand Integrated Commercial Trust. It has a bearish sell-off, I think, in response to that. So, but it may look like a correction. Target resistance is still at 2.35 to 2.33. All right, so with this, I think you can look for the support at 2.10 to 2.12 to gain upside momentum once the sell-off was halted. All right, this sell-off, I think, is just a one-time momentum sell-off. All right, but major support, I'm still aiming at 1.91 to 1.95 for the overall ascending triangle or ascending wedge formation. All right, so with that, I pass my time back to my colleague. Thank you.
Okay, we have one question. What's your view on CSC and ComfortDelGro? We don't cover CSC, but I think for ComfortDelGro, we still have a buy. It's our way to play the recovery in Singapore, recovery in economic activity. But you won't get that full recovery until we get until more people come back to the office. But we do see the taxi numbers are picking up and so forth. And also, if there is a renegotiation on the with SBS Transit on all the rail lines, then to the new framework, I think we mentioned this a few times ago, since last week, then that could be another positive for us for ComfortDelGro. And it's basically our way to play the recovery, and I think the stock is still like 20+% from the pre-COVID levels. So that's our view on ComfortDelGro. Next question, SIA, what's the effect of a change in oil price versus the book? Sorry, this one is a bit complex because I don't think they give the hedging details, if I'm not mistaken, and we don't cover SIA, so this one's a bit tough for us to answer probably. So rather than give you a wrong answer, we're not very sure how to compute that. Yeah, so sorry for that. We need to skip that question. In the long term, what's the impact CapitaLand restructuring on? I think you answered this, right, Natalie?
Yeah, I answered that. Just
okay.
Actually, in the long term, I think things should normalize. Just maybe some initial selling pressure.
And sometimes these things can work in a vicious cycle. I think if I'm an existing shareholder, even though I like it, but if I think people are going to be selling, there's a huge amount of shares coming up, and then everyone, it can be just a vicious cycle. People might just decide I sell first, then I'll buy back later. Yeah, okay. It has nothing to do with the fundamentals, but I guess there's a selling pressure coming up. Okay, this one on REIT, I think Jeffrey, you want to, and Yoma also.
Okay, hi guys. Yeah, so let me just read out the few questions that I see. Okay, the first one, has the Yoma management made any adjustments to their operations, for example, follow? Right now, I haven't received any updates from them yet. But from the last update, I do remember them saying that as of date, there's no changes to their operations. It's just that as mentioned in the previous few webinars, like some of their operations have been halted, like for example the construction segment. Yeah, so this is about it for the Yoma side. What would be the worst case scenario for Lendlease REIT in case of increased interest rates? So as mentioned earlier, REIT mentioned that their interest rates are 100% hedged, so the REIT will be protected against rising interest rates. But in any case, any refinancing needs will only happen after 2023. So within the next 3 years, we are not seeing any issues with rising interest rates. And I think there is one last question for me on iREIT. So why is iREIT Global's share price declining? Why is iREIT Global's share price keeps declining? So actually over the past 1 to 6 months, the share price has more or less been stable. I think over the 1 year horizon, the share price actually improved substantially from the pre-COVID levels. Oh, sorry, from the COVID levels. Yeah. So I think on 4th March, the share price actually dipped a bit. It was actually the ex-dividend did. So I think that's more or less the reason why the share price fell a bit more on that day. Yeah. So I think this is all the questions for me for now.
Okay. Let me just take for the CapitaLand deal, if it's such a good deal for existing shareholders, what's the motivation and benefit for Temasek to undergo this exercise? Because Temasek will still be a CapitaLand shareholder, and I mean, they do their maths. They will take it at 0.95, but they see the re-rating in CapitaLand as in total, it will still be net a positive for them, even though they do this deal. And although the market doesn't recognize the development at 0.9 times, but but I'm sure they can get back more than 0.95 times, because development profits is not at the book value. So I remember I don't have the numbers, but if you add in profits, they will obviously can get back the 0.95 times, because there's probably unrecognized revenue and unrecognized gains at the development, number one. And number two, when you do the sum of parts, because at this rate, they're not getting anything on CapitaLand. It's not really a good performer. But if they get the big re-rating at the new CapitaLand, then maybe the net they will still benefit. But it's a good question. I mean, why they do such things, right? Obviously, yeah. Thanks for that. Yeah. Natalie, you want to go answer some of them? if CICT, okay, I answered that. Okay, let me just answer this one very long question. But anyway, just talking about the trans-Pacific shipping rate rising 4 times. Yeah, I hope. Yeah, that's true. I'm so not happy. It affect my Q10 purchase. But anyway, if you look, there is no. If you look at the last week that we showed you the amount of containers going into the US. If you use the number of containers or TEUs going through the LA port, it's actually up 45%. So there is some truth. I mean, you can put conspiracy theory on it, but if you just look at the amount of imports going through the LA port, it is huge. I mean, it's like record numbers going through. So there is some fundamentals backing it. I mean, whether it should go up 4 times, I don't know, but the import numbers are very strong in the US. I hope that I'm not sure about the unemployment thing. It's not the question. I hope that answers it. Thanks. Take a few more. What's the CICT sell down new buyers? How does it benefit new buyers? Natalie, you want to talk about CICT? I think buy cheaper, I guess, if you're a new buyer, but you get the initial sell down. The question is, if CICT sell down, new buyers buy in, how does it benefit new buyers?
Okay, I guess the best way to look at it is, right now, if you're a CICT shareholder, you have 2 options, obviously. One is hold, one is sell. Sorry, the third option is obviously you wait for the share price. If it drops, you can average down if you still believe in the investment merits of CICT. And new buyers who are currently not shareholders, of course, if the share price does fall, then that just means that you have a better entry price. Yeah. But of course, I just want to reiterate that we believe that this near-term volatility with regard, especially because of this transaction, which is likely going to be short-lived, and eventually the share price will trade more based on the fundamentals of CICT. Yeah, just that there will be some near-term volatility. Yeah, that's all.
There was some earlier. Can someone explain what's AEI? But let me just take this on because you came on so early. So sorry we took so long to reply to you. What's your view of Phillip Global Quality Fund? You're asking us talk about own product, right? So whatever you say, just take it with a pinch of salt. But all I can say is that this global equity fund that we launched is a sub fund. That means it will invest in another fund called the GMO Quality Investment Fund. I can't say it's good or bad, but I guess you have to ask why we have to pay extra layer of fees, right? If you buy any fund, because you're buying a fund of funds. So not only do you get the fee at the original fund, you're going to get another fee level at this other sub fund. But again, it's up for you to ask that question. Yeah. I've got no comment on it because I don't really know much about it. Can you explain the AEI for some?
Okay, sorry, I actually missed this question. So what is AEI? AEI stands for Asset Enhancement Initiatives. It is something that the REITs or rather property managers frequently do for their assets. So as due to the passage of time, there will be some wear and tear towards the building. Some of the machinery needs to be updated. And especially when it comes to some of your commercial assets like your offices and your retail malls. Nobody wants to go to the old mall, but then when there's always a new mall that hits the streets, there'll always be some attention, and also of course the age of the asset will affect its demand when it comes to tenants leasing. So with regard, for example, the 21 Collier Quay asset, I think it was leased by HSBC for more than 10 years. And it was on a master lease kind of lease type where HSBC was responsible for the entire asset. So in terms of upgrading works, refreshing the lobby, the lifts, upgrading the lifts, that wasn't really done. So when the HSBC lease was ended, came to an end, then this was an opportunity for CICT to then come in, refresh the building, and also of course dovetail some of the construction costs with WeWork. Yeah, and obviously to give a more refreshed product to the tenant WeWork. Similarly, for example, like there's some AEIs. It can entail carving up some space. For example, if a space was previously occupied by a departmental store, and then now they're going to carve it up into smaller spaces for multiple tenants, that might actually result in an uplift in rents, because larger spaces, the landlords tend to give a small discount for the space. So therefore, that means the rental reversions would be higher because of carving up the space. It's stuff like that. It could be conversion of an area that was previously not leased out, like the walkway. It was just a walkway, but now when they pumped in some money and carved up, created shop units along the walkway, then you can charge rent. So those are the kinds of AEIs that REITs do undertake. Yeah. Sorry, there's another question here on CapitaLand restructuring. Give me a minute to check that again. Yeah, Timothy can take the next question.
Okay, the question is, 10-year treasury bond yields are increasing. Does it mean any bond price, the price will drop? No. So there's different types of bonds with different types of maturity, and we're only looking at the 10-year treasury bond yield. So if you look at the short-term interest rates, the short-term treasury bond yields, it's still very flat, because the Federal Reserve is still keeping short-term rates low. So usually, what this means is that usually we are seeing more of the long-term bonds take a bigger hit from this treasury bond yield increasing. So we are seeing the high yield bonds outperforming the more of the investment grade bonds, because high yield bonds are more shorter term, and they also provide a higher buffer because they provide a higher yield, so they provide more buffer against a rising government bond environment. Also, perpetual bonds may come into a better light in a rising interest rate environment as well, because of a lower non-core risk. So not every bond is affected in the same way in a rising interest rate environment.
Hi all. I think the time is going to be up soon because me and Junrong is going to prepare for the next webinar at 1 p.m. So we welcome any emails that you have to email directly to us. These are our contact pages. So if there's any question, please email to us or go to our community page at stocksbnb.com. So thank you for everyone for joining in, and then I'll see you on next Wednesday. All right.